Look at the chaos of the early stock market. For decades, trading was an exclusive club, requiring vast amounts of capital and specialized knowledge just to get a seat at the table. The biggest hurdle for an everyday investor was the math of risk. If you only had enough money to buy shares in a single company, your entire financial future was tied directly to that one business. If they failed, you lost everything. To avoid that trap, you needed to spread your money across dozens of different industries. But building that kind of safety net required the massive wealth and institutional power that only Wall Street elites possessed. Eventually, the financial industry developed a structural bypass to this massive barrier to entry. It's an investment vehicle designed specifically to let people with limited funds participate in the broader market. We call this a mutual fund. By rethinking how capital is gathered, it opened the doors of wealth building to the general public. The underlying mechanism of a mutual fund is simple. It takes your money and pools it together with capital from thousands of other investors. Suddenly, your small contribution is part of massive combined buying power. When you buy a share of this fund, you aren't buying a single stock. You are purchasing a tiny fraction of everything that massive pool of money owns. This structure creates diversification. Diversification is a strategy that reduces risk by spreading your investments across many different companies, industries, or asset types. Because your money is spread so wide, the danger of an individual failure is neutralized. If one company in the fund goes bankrupt, the overall structure of your investment survives because it is supported by hundreds of other successful companies. The fund effectively takes the extreme, concentrated danger of picking individual stocks and turns it into reliable, distributed stability. Once the money is pooled, a fund manager puts it to work, usually in one of two main categories. Stock funds buy shares of publicly traded companies to pursue long-term growth, while bond funds buy government or corporate debt to provide steady, stable income from interest payments. But a pool of money doesn't direct itself. It requires professional management to steer those assets toward a specific financial goal. Some of these vehicles use active management. Active management is a strategy where a professional manager handpicks specific investments, buying and selling them in an attempt to beat the average returns of the overall market. Take a look at this monitor screen showing rigid columns of market indices. This data is the map for passive management. Passive management, often seen in index funds, doesn't try to beat the market. It simply buys all the companies in a specific index, like the S&P 500, to match its performance while keeping trading costs low. As an investor, you don't need to stress over picking winning stocks. Simply pick the management philosophy that fits your goals and let the fund execute the strategy. Look at this ticker screen showing volatile daily market drops at the closing bell. With underlying stocks jumping up and down in this chaos, how do we actually figure out what your share of the mutual fund is worth? We use a metric called the net asset value, or NAV. NAV is the price of a single mutual fund share, calculated by taking the total value of the fund's investments, subtracting any liabilities, and dividing that by the total number of outstanding shares. Individual stocks fluctuate by the second, but mutual funds process this math differently. They wait for the market to close, tally everything up, and lock in a single updated price for your shares once per day. Of course, the professionals calculating that NAV and managing the portfolio don't work for free. They charge operational costs, which are expressed as an expense ratio. An expense ratio is the annual fee that all funds charge their shareholders, represented as a percentage of your total investment. This chart illustrates the danger of high fees over time. By looking at these two growth curves, we can see that a seemingly tiny 1% fee difference heavily degrades your compound growth over a span of decades. Grasping the internal math of these expense ratios is crucial. It is the best way to prevent hidden administrative costs from draining the wealth you are trying to build. Ultimately, a mutual fund is a powerful mechanism designed to capture a piece of broad, global economic growth. It absorbs the intimidating complexity of the international market and packages it into a highly accessible, streamlined tool. By selecting a matching fund, checking its historical risk level, and ensuring the fees are low, you can essentially put all of your future savings on autopilot. Building wealth doesn't require Wall Street insider knowledge or constant trading. It requires utilizing efficient, diversified tools, consistently contributing over time, and letting compounding growth do the heavy lifting for you.